Welcome, everyone. And I've got a really special guest with me today, Brad Lazarus. Welcome, Brad, to the
Thank you.
podcast.
Hi, how you doing?
I'm all right, thank you. We were just having a quick chat before we started recording, and we were discussing the market. We've had a really good run in the markets, and it's kind of almost gone up in a straight line. And actually, it's quite healthy to have a pullback every now and then, isn't it? Because you get used to, almost get complacent when the market's going up all the time. And markets are not meant to go up all the time, because then it would just be too easy, and then it would stop going up in a perverse kind of way. So you actually need pullbacks. You need corrections for two reasons. One is so that makes market growth more sustainable. But the second reason is because it allows us to capitalize as smart investors. It allows us to capitalize and buy into the corrections, pound cost averaging, dollar cost averaging, and that's what really turbocharges your returns, right? And on options, I know we're going to talk about your sort of experience investing with options.
Yeah.
With options, you get the double benefit, which is that something called implied volatility goes up, which means you get even more income on your options trades. So these are times to really capitalize on.
Yeah. And I think the other thing as well, I think it's almost, these pullbacks almost give you a reason to get engaged in the market, which I think, because if the market just keeps going up and keeps going up, you almost go, well, I won't look at it today because it keeps going up. But if you get these pullbacks, I think they engage you in them. It's like everything. You learn more from mistakes and errors and failures than you do from successes. In the markets, you probably learn more from the pullback than you do from a straight upwards growth.
I agree. Yeah. And if you look at the market this year for 2024, we're still up around 8 to 10% already.
Yeah.
And that's the sort of, in a typical year, that's what you would expect. So far, we're in August now, we've already achieved that. So it's completely to be expected. So the way I look at these things, some people, you see the headlines and you see kind of social media commentary and hear about the frenzy about the sell-offs. But actually, when I look at these sell-offs, I see it as an opportunity. I'm rubbing my hands with glee because I've got some cash sitting around, and most people do. And these are the times to be deploying that cash. So for me, it's very much a green day.
What did we say before? Cost averaging, dollar cost averaging, pound cost averaging on steroids.
On steroids, exactly.
Yeah. I've got a lot better at that over the last 18 months, a year, just being patient with cash on the side, waiting. And if you're engaged in the market and you see what's going on, you're almost like a sniper. It's a bit like that.
I agree. And the final thing to say on this, by the time this episode goes out, we'll be wondering what we were talking about, because the likelihood is it will be back to normality and the market will be recovering.
We will have breezed past the all-time high and wondering what the fuss was about.
Yeah, as it always does. So we'll be, and if we didn't capitalize on this, we might be kicking ourselves. So always look at these things as an opportunity.
Yeah.
So Brad, you're a graduate of the Investment Academy. We've known each other for, 8-9 years.
Pre-Investment Academy. Yeah.
Pre-Investment Academy in this current format. And I think we met at a property networking event, didn't we?
We did. I think it was in Harrow. I don't think it exists now. It was in Harrow.
Yeah.
I was trying to double down on property at the time, hence being there. So I remember we met there. Yeah.
Yeah. So we hit it off straight away, didn't we? Because we'd started talking about property, but actually I discovered you're an expert on online marketing and business development, that sort of thing. And I was very early stages of thinking about how I'm going to take my investment knowledge. And you gave me a whole kind of world of ideas that just opened up to me in that conversation. And you're probably the most influential in terms of me shaping what I'm doing now, in terms of the Investment Academy, in terms of how I communicate to investors. And I remember you saying to me very clearly, it's all about content marketing and delivering value to the audience. And I just love that aspect. Before I met you, I probably wouldn't have even considered how to go about.
Yes. Well, I think I always consider it as being packaging up your IP, your intellectual property. How do you package that up and deliver that to an audience where it's digestible and you can take people from zero to hero in their own kind of life, if you like? And when we had that initial conversation, and then we used to do coffee and all that kind of stuff, didn't we, for years after that, there was an exchange of ideas, because at the time I was a very green investor, and from an influential perspective, you also sent me on this path, which I've never looked back from, really. So no, it's been a very fruitful relationship, hasn't it?
It absolutely has, absolutely, and there's such a great sort of exchange of ideas every time we meet. Yeah. So, and you've really, as you mentioned, you've really taken investing to a new level, and in many ways, you're a model student because you came into this process without kind of having any investment expertise, right? I think, is that fair to say you weren't doing much investing when we first?
I guess I was in a situation that many of your students are when they come in to invest like a pro. I was putting money into a pension. I had an interest in property. I can't really say that I was any more sophisticated than that, really. I didn't really know which way to take it and stuff, really. So yeah, I would say that's probably about right.
And so it goes to show that to succeed in investing, which I think, you certainly have, right? And we'll talk about what your investment journey looks like and what you're doing now and what kind of returns you're generating in both your kind of set and forget portfolio and your options portfolio. But it goes to show that you don't need to have investment expertise, investment experience, any specific knowledge or know-how. Anyone can pick up investing. It's super simple to do. You just need that initial confidence and some know-how to run with, and you can have a very successful career in investing, in passive investing. Right? Would you agree with that?
Oh, 100%. It depends on how far you want to take your kind of investing. By how far you want to take it, it's like, how active do you want to be? I'm somebody that, we laugh about it, but I'm somebody that will just burrow down rabbit holes until I get to the center of the earth, kind of thing. I'll just keep borrowing. I enjoy that. I'm ridiculously curious. And it's a blessing and a curse sometimes as well for me. It's a blessing because I'm always learning new stuff. It's a curse because when do you rein this in terms of the amount of activity? But for me, it's a case of, how do you get the confidence? Because if I look back to the level of confidence that I had in being what I consider to be an active investor, if you would have told me 7 years ago, you'd be options trading and doing pretty okay out of it and doing the kind of options trading with the significant sums that I'm trading, I would never, ever have believed you. I just absolutely no way that I would have thought I'd been able to do that. But just inch by inch, getting engaged in it, understanding risk, reward, all of those elements that you teach in the academy, you move forward. And what you thought was quite a tricky kind of concept becomes part of your thinking. You don't even think about it. So I was saying this to somebody that I'm talking to at the moment who's getting into options. I said, and this isn't just options, it's investing generally. I think it's like learning another language. And you can't learn. It's like the best way to learn a language is go to the country and learn it and go and speak it. And you've got to learn actively, I think. And that means being engaged, but at the same time, knowing what you want to achieve, where the boundary is for you in terms of how active or not you want to be.
Yeah. And you mentioned going down rabbit holes. You are a champion at going down rabbit holes, honestly.
Thank you. I'll take that as a compliment.
Because there are times when I've mentioned something to you and you come back to me a week later and you're teaching me stuff about this stuff, right?
Oh, no,
and I'm thinking,
insane.
wow, this is great. Next time I want to learn something, I'm just going to mention it to you and you're going to come back and teach me all about it. And options is something you've really mastered. Honestly, there are times when I'm picking up the phone to you and asking you questions about stuff.
Yeah, no, it's great because it's a good exchange because you need to speak. I always say there's nobody. I live in Finchley, Northwest London. There's no one local around here that wants to talk about options. So and a lot of the time you talk options through Facebook groups or a Discord group that I'm on, that type of stuff. But to actually pick up the phone and talk to somebody about a trade idea or how this is going or that's going, it's within options and investing generally is such a valuable thing to have. I think
it is, and we have a good sort of community now of sort of investment academy graduates in our Facebook group and in our private Facebook group, which obviously you're a part of, and we have masterminds, investment masterminds.
That's always very good.
Yeah, and that's a great forum for us to get together and talk about what we're up to and the kind of challenges we're facing, or issues we're trying to solve, and I think that works really well. So what about your sort of general investment journey? What else are you up to apart from options? We'll come back to options later, but in terms of general investing.
Yeah, for me, it's primarily index, like ETFs, the kind of standard kind of stuff which forms what you in the academy would call the core. And then options is obviously a significant part now. And then you move into areas like, okay, well, you have your ISAs, like you say in the academy, you want to max out your tax-free wrappers, which is obviously the ISA and then your pension. But then I switched everything to a SaaS pension. So I now, in the SaaS pension, I semi-replicate everything I've just mentioned in terms of all those buckets, if you like, inside of the SaaS. So I'm actually trading options inside the SaaS now as well.
Yeah. Well, that's one of the benefits of having a SaaS, because you can actually do options in your SaaS. So you can not only earn the income through options, but earn it in a tax-free wrapper, which is really useful because you can't do options in an ISA. So for a tax-free wrappers, SaaS works really well. There are some SaaS providers, they're not great. A lot of the SaaS providers will allow you to do options. So that's great. It's all passive though, right? Everything you're doing is not really hands-on. You can do from your computer, and it's pretty hands-off, would you say?
How passive is passive? I guess it's that kind of that conversation, right? It's like a lot of people think that having 3 rental properties is passive income. Well, if you speak to the landlords who's got 3 rental properties, you probably tell you it's not as passive as one is led to believe. And I think anything that gives you the consistency or the returns above maybe the standard S&P, you're going to need to be a little bit more active with, is my take on it. I don't know if you agree with that.
It depends on your objectives, right? So it depends on when you first go through the sort of in your investment approach, what are you going to be investing in? You always want to sit down and think about what your objectives are, what is your risk profile, and then fit everything around your objectives and risk profile. So and that determines what you invest in, right? So if you are looking for kind of market beating returns, the market delivers 8 to 12% per annum. It has done for decades, if not centuries. And that's very passive. You can just buy ETFs and passive tracker funds to give you that. And if that works for you, which it does for most people, that to get those returns on a consistent basis over a number of years, that's going to compound up very nicely. And then you can remain very passive. But if you are looking to attain returns of, say, 15, 20, 25%, then you need to step up your level of...
Yeah. What's interesting about that, though, is because at times when the S&P or the market is getting 8, 9, 10% a year, and you've got a secured loans portfolio, which is getting 8, 9, 10% a year, you're thinking, what am I bothering with this secured loans thing for? I could just throw all this into the market and buy trackers and I'm done. And then the market dips, but you don't see the dip in the secured loans portfolio. And that's when you go, oh, okay, fine.
Really, the biggest difference for me is that with secured loans, you're picking individual loans, individual developers, individual projects, and you can potentially lose your entire capital in one of these, right? So that's the difference. Nobody's ever lost money investing in stocks in a diversified way, right? So that's the key difference, because stocks have never ever lost money, but there've been some high profile failures in property projects. So you have to be highly selective. You've got to make sure that you pick the right projects. And really the key point here is you have to differentiate between volatility and risk. And with stocks, you get volatility. Of course, that goes with the territory. Of course, on a daily basis, they move up and down. You see that and it's visible. Whereas with other asset classes, that may not be so visible, but you get risk. With stocks, you get the volatility. With other asset classes, you get risk. And if you pick the wrong secured loan, you've got risk of losing your capital in its entirety, but you don't see the volatility. I think that's the difference.
Right. And therein lies that how active do you want to be in secured loans? And I went down many kind of hours of rabbit holes learning about what makes the secure bit of the secured loan, I guess, is ultimately what it comes down to.
With development, and I think what you're referring to is bridging loans versus development loans, right?
Correct.
Yes. And so with bridging loans, they're pretty vanilla, right?
Yeah.
They're a loan to an established property, which is maybe already cash flowing. and it's pretty simple. Whereas with development loans, there are so many moving parts, right? So many different levels of risk. So the risk of construction, the risk of cost increases, the risk of your end values going up and down. There are so many variables which you have to factor in. So the risk levels increase pretty significantly without you getting compensated for the additional returns that you're taking on. And most people don't know those most people aren't aware of those additional risks that they're taking on.
Yes, 100%. And I think if you wrap that risk up another level, I dabbled in equity investments in property developments. And I'm pleased I just dipped my toe in the water there, because that's risk at a whole other level. And it's interesting talking to some people in the property business, in the property game, landlords and what have you, and people don't understand the difference between debt and equity. And they're almost property is the vehicle, but they almost feel like two different asset classes in many respects.
I agree. I see posts all the time on Facebook and social media about people advertising opportunities, and they have the words expected return of % or something, which sounds quite exciting. But then when you delve deeper, this is over an expected 2 or 3 years, and the security is a personal guarantee, which is pretty much meaningless. And when you do the annualized returns, you take off the tax and everything, you think, why on earth would you take on all those risks for a return that is so uncertain?
I can say I literally had a handful of dip my toe in the water equity investments, and none of them came off anywhere close to what the expected was.
Yeah.
From a returns perspective and the time perspective. So that was when I understood. I remember us talking about this a while ago, and you basically said, oh, well, that's debt returns with equity risk. Is that the phrase? Yeah, that's put everything into context for me now. I'm not going anywhere near that stuff again. So that's kind of part of, go back to the original question, which was how active do you want to be? People talk about you want it to be passive, you want it to be, actually, if you're interested in this stuff, which I am, get active, because you learn a lot. And that was my first almost kind of experience, if you like, of being quite active in investing.
Yeah. So the reward for being active is that you get a higher return than what the market has delivered historically. And that's why you're doing it, because that's your reward. And if you want to stay passive, you can, but you're going to get the market returns, right? So it depends. Again, we come back to, what are we looking for in the first place? What are our objectives? What are our return targets? And you can be very passive, getting market returns, 8 to 12%, which certainly beat inflation, which can be tax efficient, will compound over time, and will get to your objectives, whatever they might be. But somebody else might have more punchy targets. So you've been investing in a pretty active way over the last 7, 8, 9 years. So you must have learned a few lessons during this time. I think our audience would be really interested in learning about what lessons you picked up during that time, and how would you do things differently now, knowing what you know now. Would you have done anything differently 7, 8 years ago when you started this process?
I think I would have done options sooner. I definitely would have done that, dabbled in that sooner, just to start that learning curve. I think ultimately, and everybody says this, I would have done this in my early 30s or my late 20s. I'm really on it with my kids now. I'm quite active in their junior ISAs. So, and I just think it's that the compounding element is absolutely massive. You don't have to take the risks if you've had the compounding over the years. So I think I would have got onto this a little bit sooner, if you like. I think maybe in the early days, I might have been a little bit more diligent on a couple of the secured loans. One's gone bad, and the reason why it's interesting, because one of the things that we haven't talked about is this whole kind of concept of cash drag. So when you're invested in the market and you've got all your funds invested, let's say, you don't need to worry about this lump of cash sitting on the side waiting to get invested, being eaten up by inflation. When you're doing secured loans and you want to stay diversified across a number of different loans, you are going to have a natural period where there is cash sitting on the side, and that pulls the overall portfolio returns down. And it also slightly forces you feel pressured into maybe going into a loan you don't feel comfortable with because you want to deploy the cash.
Just to deploy the cash, you become a motivated investor, don't you?
Exactly. And actually, looking back now, I wish I hadn't been such a motivated investor at times. So that might be a regret, if you like.
Yeah. And whereas with stocks, because they're liquid, and same with options, you can get invested pretty quickly in a diversified way, and it reduces the amount of time your cash is sitting around doing nothing. Right. So that's one of the positives. But I remember actually one other thing I would add is going back to our kind of early days when we were first getting to know each other. I remember, correct me if I'm wrong, I remember you were very pro property, but not very pro stocks. When I checked what you were invested in, you didn't really have much exposure to stocks, equities, options, financial markets. But that's really changed now. It's almost an about turn now, right?
So I was putting money into the pension. Well, you're not really putting money into the pension. You're putting money into the pension, and that's being invested in the market. So you don't really, most people have no transparency over that at all. And it's almost quite difficult to get that transparency, to see what is behind the pension kind of title, if you like. It wasn't that exciting, I think. That's probably what it was. And I found property exciting, and I could understand it maybe a little bit more. I think maybe that's what it was. So even though I was exposed, I wasn't engaged in my own investments, if that makes sense.
Yeah, I think it's really common. We understand property because we live in a property and we understand how property works. I find when people join the investment academy, they're almost coming along to have the whole world of stocks and financial markets demystified. And the reason they haven't invested in the first place is because they just didn't understand things. And the default kind of action is to do nothing, right? Maybe you can relate to that because you didn't quite have confidence in stocks and the compounding power and the inflation beating returns that they've always delivered. And many people don't understand that because they just see the headlines and they see what the perception of stocks is. And it's not a roller coaster, right? It is a real it's a real investment that generates inflation beating returns, always has done, always will do. So that's kind of part of the challenge which some people have. I think, and maybe you went through a similar journey, it sounds like.
Once you actually demystify it, it's a super interesting kind of space. And obviously being involved in options, you naturally then, you need to be looking at the market.
So fast forward to today, how are you doing? Do you want to share some of the success stories? What kind of returns are you achieving in your equity portfolio and your options portfolio?
I have two different attitudes to risk reward within my pension, the SAS, and the general account. So I'm generally targeting in options, I'm targeting a 30% return a year. That's what I'm targeting. And then in my SAS, I'm targeting anything up to about 20% return. So it's less risky, but still punchy comparatively to the market, I guess you would say. Standard market returns. The other thing that I've learned in options is you need to find a style of trading, I think, that you're comfortable with, that suits your personality, it suits the amount of time that you have, how active you want to be, how engaged in the market you want to be, how much more learning you want to do around options. There's so many different facets of it. And it's about really trying to understand where you sit in that. And that's taken me a good 2.5 to 3 years to go, okay, I feel like I'm this type of a trader now, and this suits my style. And if you would have told me 2.5, 3 years ago when I sold my first put option that I was going to have a certain trading style that suited my personality, I wouldn't have had a clue what you were talking about. No clue. Yeah. Now it makes total sense to me.
I'm a pretty lazy investor when it comes to regular sort of passive ETFs and when it comes to options. So I do the vanilla kind of strategies, the wheel strategy, and the cash secure puts, which kind of give you the steady eddy sort of 1 to 2 to 3% per month. But you can tell from what Brad's doing, he's targeting a lot more than that. You made a great point about investing according to your personal style. Yeah. And that's always the way, right? Whether it's your personal risk profile, your objectives, or your style, how passive or active you want to be, right? And that's discovering your style. That's the key thing, I think.
We talk about, or you teach us about diversification, right? So when you go and start in options, you want to be diversified. Well, you can diversify. Generally, the thinking is, well, I'm going to diversify by underlying. Okay, so I'm going to sell a put on this stock. I'm going to sell a put on this index or that index. And you want to try and find that balance between, well, if the market goes up, this trade's going to come good. If the market goes down, this trade's going to come good. And that depends on the underlying, right? The big turning point for me was, how am I going to grow? How am I going to find a scalable option strategy that allows me to spend a limited amount of time per day? And if I want to take this account up to 500,000 or 1 million even, how am I going to do that? And I'm not going to do that by selling one contract on this and one contract like I was doing before. I needed so it's that kind of classic case of what gets a business from 0 to 200 grand turnover is the totally different strategy from what gets it to 200 to 5 million turnover. So it was almost that was the thinking that I was having to go through. And that's when I shifted my kind of strategies, if you like. I know we're not going to go too deep into the technical side of it, but there's a number of different strategies which weren't complicated. Just fundamentally, everything starts with selling a put, right? That's really what it comes down to.
So what you're talking about, for the benefit of our audiences, are strategies which enable you to apply leverage, right? To optimize leverage, because with options, you can do them with cash, but also once you're a little bit more advanced, you can apply leverage. And what you're talking about is, you mentioned futures, options on futures enable you to really make the most of the available leverage to increase your return.
And beyond that, talking about the diversification. And so what I wanted was a system. I wanted a systemized, repeatable process. So again, going back to your kind of key concept of core and satellite, the core of what I do now are what I call campaign trades. These are trades and they are all on essentially the S&P futures, which is known as /. But my diversification, so I'll have 8 or 9 of these trades on at any one point, but the diversification is strike price and expiration date. So that's where the diversification comes from now. So we're still trading primarily 80%, 70% the same underlying, but that diversification comes from a different expiration period, a different strike price. When you place the trade, it happens every 2 weeks, and it's all campaign style, basically. I don't use screeners anymore. So if I just did the straight up campaign trades in my general account, it would probably be about a 20% return, roughly. And then I take a satellite where I'm doing some strangles, for example, which I know you touch on strangles in the options course, but those strangles boost the returns up another 10% to about that 30. Okay. So it's an 80-20 kind of 80 core, 20% satellite.
Right. Okay. So when you talked about your 30% annualized returns,
yes,
that's really made up of a core and satellite approach. So your core is about 80% of your overall strategy.
Correct.
There's 20% returns of the 30. And
yes,
then satellites is 20% of the portfolio, which delivers an additional 10% return. So
got it right. And it takes a little bit of management, but it's relatively passive. One other thing around that is I have a plan. I never had a plan before. It was quite sporadic. And so now I have a trade plan.
In my view, this is exactly what separates a successful, long-term, sustainable investor compared to somebody who doesn't really understand how to set up their portfolio. And this is all about being a portfolio manager. A regular investor, a typical investor, would approach investing in terms of individual stocks and individual trades. They see something being mentioned in a magazine, or their friend down the pub mentions a stock or whatever. So they end up putting together randomly selected stocks without any process. It becomes a mishmash. But when you set up your portfolio in a properly structured way, which is actually, it's not very difficult to do, properly diversified using the core and satellite approach. And this applies not just to options, but to equities, ETFs, stocks. When you put things together in a properly structured way, as you're doing, that lays the foundations for long-term sustainable returns. And you're not going to get blown over by things that are unexpected. You're going to have sustainable long-term.
Well, I think if you put that plan together, I think if you put that, you mitigate the risk of being blown over.
It's fascinating. You've been doing this for a while and you've taken it to another level. You're getting great returns. For somebody just starting off at this start of the process, who hasn't really done options, hasn't really done ETFs and diversified structured investing, what would be your advice to them?
I think investing, the core principles of what you teach in terms of the core investment strategy, I don't think that's overwhelming. Give yourself time. Don't put yourself under too much pressure to know everything in the next 6 weeks, not even in the next 6 months. I always say this is a process, not an event, right? I'm going to spend an hour and then I'm going to know everything that I need to know. I know a lot of people don't think like that. I'm going to spend 10 hours on this and then I should know everything that I need to know about this. I'm not necessarily sure that works. If you haven't done investing, get an ISA open in Hargreaves Lansdown or AJ Bell, whatever it is, and start averaging in a bit, but know where are you averaging in the grand scheme of the market, right? Start to understand, why am I buying it at this price? I could set something up where I average in every single month. Great. But then if that's all you want to do, but go back and see where you bought. I think that's an interesting, where did I buy? Get a chart of the S&P 500 out. Go and see where you bought and where does that sit within the context of the market over the last 12 months that you've been averaging in.
Yeah, that's one way to do it. But if you look at the longer horizon, and if you're investing for the years, it actually doesn't really matter, right? If you pound cost average consistently, drip feed money into the markets, it actually doesn't matter which price you bought in at and all of that stuff. That's almost noise, because over the long term, the consistency of returns in the markets is there for us to see. Zoom out on any chart and you'll just see the markets have consistently delivered returns. So you can do it in two ways. One is keep an eye on where you're buying, which is what you said, or almost close your eyes and just invest Consistency is the biggest thing in my view, because if you invest consistently, if you ignore the noise, if you do it all in a tax efficient way, and if you minimize your fees, all of those are all the ingredients you need to have long-term consistent returns. That's all it really requires. And be diversified, right? That's all you need. And honestly, people agonize about, should I buy Nvidia, or should I buy Tesla, and should I buy this crypto, or should I buy gold, or should I buy the S&P 500? All of that stuff makes zero difference, right? In the long term, it's irrelevant. Right? What's really going to move the needle for your long-term future financial security are those things I mentioned. Be diversified, be properly structured in your portfolio, reduce fees, reduce taxes, and invest in a consistent way. That's really what's going to move the needle.
I think, on that long-term horizon, definitely. And I think if you do that, I think my point is if you do that and you find, oh, hang on, this is interesting, I'm feeling quite engaged in the market, then maybe that's the next step to go, okay, let me burrow down this rabbit hole and see if there's how can I get more active and therefore edge my returns up, maybe.
Absolutely. And that's why I think satellites, right? Because your core does its stuff, it just does its stuff in the background. But if you find something you're really engaged with, put it into one of your satellites, which are a smaller, it's a smaller bucket of your overall portfolio. And that can be more engaging, more fun, and more active.
Yeah, it's almost like it's almost like a therapy bucket in a way. It just gets the risk element out of you. It's like, okay, if I want to FOMO for whatever reason, let me go and do it there. If I'm going, you shouldn't be FOMO. That's one big lesson that I have learned in the last 2 years: is just relax. Everything will come back. It'll be okay.
Absolutely. And the difference is, the typical investor would probably put a large part of their portfolio into these satellites, as I call them. Whereas when you structure your portfolio properly, you should limit the amount you put into these kind of more active, engaging satellites, which, to manage the risk in your overall portfolio, treat these as smaller buckets within your overall. And that's what I think will give you sustainable returns over the long term. This has been a really fascinating conversation.
Oh, good. You know what? I never quite know, because most of the time when I have these conversations with people, they glaze over.
Well, hopefully our audience won't glaze over, because there's been some really interesting nuggets, some really important lessons. And you, as I mentioned right at the start, you're a model student, because you've not only embraced everything I teach, but you've taken it to another level. And for you, this is a big part of your life now, the whole passive investing angle. Isn't it right?
100%. The skills that I've learned in the last few years are just for life now. I can see myself trading options well into just before my death. I don't see how that changes. I find it engaging and interesting. It's been a fascinating journey.
And just to finish on that note, you talked about how it's with you for life. And earlier you talked about how you engage your kids into this whole kind of activity, the whole process as well. So, and I try to do the same. It doesn't always work out. What do you actually say what is the advice you give to your kids? And what
It's interesting because you sometimes come off as a bit of a secondhand car salesman. It's like you're trying to sell something that they don't necessarily want to. I try to get them vaguely engaged in what is going on, as in I'll show them inside their ISA account and I'll show them the percentages, and this is the percentage return that you've made in the last 2 years, and here's the lump sum. Think about what you could buy with that lump sum if they're ever allowed to touch it. But it's like, just try to bring it into kind of real life to a certain extent. I've been buying a bit of Tesla I'm quite bullish on many things stock wise or anything like that, but I am quite bullish on Tesla. So I've been buying them a bit of Tesla, and I've been showing them these are the things that you're buying into. These are the elements of Tesla's plan in the next 5 to 10 years that you have bought into. And if they're successful, this X amount of money is going to grow. So it's a little bit like that. And I bought them some Bitcoin as well. And this is satellite-y type stuff. So let's not panic too much. Yeah.
I think it's great to get them engaged in something they can relate to. When I talk about being diversified and talking about ETFs, I say to them, look, when you buy a diversified tracker fund, you own a bit of Microsoft, you own a bit of Apple, and you own a bit of Tesla, as you mentioned, right?
Yeah.
And so that engaged them because they themselves own an Apple phone. They use Microsoft in their devices, and it gets them invested. It becomes a real world thing, right? The investing is not just a few digits on making returns. It's about owning a piece of these real businesses which shape the world. And I think
and trying to get them to join those dots. It's quite challenging. Look, it took me years to get engaged. I want to teach them that. I use the 80-20. 20% needs to go off into savings, and 80% you can do what you want with it. And then there's lessons around that. And I remember one day, I think my son got he got £20 for a birthday present, and he put it on my desk. It was a £5 and a £10, and I think he put a post-it note on the £5, and he went, invest this, and then he put a post-it note on the £10. He said, transfer this to my Revolut.
Wow.
I was like, yes, indoctrination is doing well here.
You're doing a good job, Brad. And,
but I think it's important. That's kind of part of that whole process, isn't it? Get into the mindset of this whole thing. It's so valuable for them now when they're so young to be compounding.
It really is, and it will make such a huge difference. So it's good to hear that. And you've obviously got smart kids who you've trained them well in the world of investing, which is gonna help their sort of future financial security. Amazing. Thanks for your time, and it's been a really interesting chat. If people want to get in touch, can they find you on social media or anything like that? Or
I'm on Facebook. I'm in the group, in the Invest Like a Pro group. Find me on Facebook. If you go to bradlazarus.co.uk, my website is there, so there's bits and you can contact me via that as well.
Perfect. Okay. And as Brad mentioned, he's very much a part of the overall community. So if anyone ever has questions and they post it on our private Facebook group, Brad's he comes up with one or two interesting nuggets occasionally.
Well, when I can.
He's really helpful with all that stuff. So he's a great resource as part of the community. So thanks again, Brad. And I just wanted to say to everyone that, look, I hope you enjoyed this conversation. I hope you got some interesting nuggets out of this. If you want to find out more and become a successful investor like Brad has become, go and check out the Investment Academy. It's on investlikeapro.co.uk/academy. And follow our podcast. We have a YouTube channel as well. So like, subscribe, and follow the YouTube videos as well. And I will see you next time. Thanks very much, Brad.
Pleasure.